Okay, traders, welcome back. Let me start off by asking each and every one of you a very simple question, right? Have you ever come to a fair value gap and you wondered why it failed, right? So I got this question on my Instagram story questions, and this is something I'm going to answer now in a lot of detail, far beyond any DM or any tweet. So this comes down to the delta. The delta is the ask minus the bid. And this is essentially telling you how many aggressive buyers and how many aggressive sellers there are. So let me start off by telling you that it's not about buyers and sellers. It's not about how many buyers and sellers there are. It comes down to who is aggressive and who is passive. So it's not a battle between buyers and sellers. It's not about liquidity, fair value gaps, the algorithm, none of that crap. It is about understanding who is aggressive and who is passive. And you do so by reading numbers and understanding what's behind every candle. So think about this. Candles are simply a representation of the auction. The market is an auction. So why wouldn't you understand what's happening inside of the auction? The delta gives you this information, and it is the delta that we will be using to determine every trade. Now, the power of the delta is what you see over here on the charts, right? So the power of the delta is that it tells you at every single price, for every single candle, at every single time, how many aggressive buyers and how many aggressive sellers there are. So what is the benefit of this information, right? So of course, the first thing is that it's very visual to understand because of the color scheme, right? So the color scheme is, of course, blue and red. Red meaning aggressive sellers or more aggressive sellers, and the blue delta means there's more aggressive buyers, right? So what that means from an ask and bid perspective is that when the ask minus the bid is a negative number, this means that the delta will be red. Hence, there's more aggressive sellers than there are aggressive buyers. Vice versa, for a blue delta, there's more aggressive buyers than there are aggressive sellers. And that's what we see over here. We see a lot of aggressive buyers over here, and we see a lot of aggressive sellers down here. So how do we use this to our advantage, right? So this is something we're going to go over in a lot of detail on the footprint charts. So here we bring our attention to the footprint charts, right? And we're going to be dissecting what's happening at this particular price movement. So we're going to be dissecting this upwards trade that you could have taken on ES futures. Right, so the first thing to understand, and this is something I'm going to be going into in future series as well, future order flow series, is that we want to be trading at a 15-minute fair value gap. So here we've identified a key level, a 15-minute fair value gap. This is a demand area. This is an area of potential support. Now, the mistake that a lot of traders make is that they blindly trade off every fair value gap, right? So if you look over here, there's plenty of fair value gaps, right? There's bullish fair value gaps over here. We had a bullish fair value gap over here. We had some more bullish fair value gaps down here before the gap, right? There's plenty of bullish fair value gaps. But what differentiates and what separates the good traders from the bad traders, or the traders from the gamblers, I should say, is being able to distinguish between a good fair value gap and a bad fair value gap. And it doesn't come down to market structure. It doesn't come down to liquidity. It doesn't even come down to time. What it comes down to is understanding the interaction between buyers and sellers and understanding who is aggressive and who is passive. Not how many buyers and sellers there are, not the next fancy liquidity sweep. And this is something we're going to be going over in a lot of detail. So if we go back to the previous slide quickly, right, what we're looking for is the ask minus the bid. So we're looking for this on the footprint chart. And this is what the footprint chart really entails, right? So let's break this down in some detail. If we head down now to the 5-minute time frame, the 5-minute time frame is where we're going to be dissecting this price action. So as you can see on the 5-minute time frame, we have this large rally to the upside, right? And we are going to be dissecting this in terms of the 15-minute fair value gap, which is in this region. Right, so as you can see, when we zoom into the candles, we're able to see a brand new world which wouldn't be open to us with candlesticks. So what I want traders to understand now in the third part of the order flow series, as we get deeper into order flow, is that we want to be understanding that the order flow essentially dictates every candle. The candle is almost like an indicator of the order flow, right? Candlesticks are not an indicator, but candlesticks are almost like an indicator. They are simply a visual and a graphical representation of what is happening behind buyers and sellers. And candles only give you so much. Because when we dissect candles over here, what we see over here is some wicks, right? We see wicks rejecting off here. But how did you know that this wick, and again, this long wick over here coming off this 5-minute fair value gap? So we also have a 5-minute fair value gap over here, and we can see price enter this fair value gap before giving us a second potential entry. So one fair value gap here and then the other fair value gap here, and they both led to pretty good trades to the upside. So how do we take advantage of this? Let's break down the first fair value gap, right? So again, we're going to be dissecting two things over here, right? The delta and the volume. So from the last session, I broke down exactly how I've determined my settings on the ATAS platform. And the way I do that is, again, quickly going to go over my settings now. Clusters, and we want to go to delta profile. So this gives us the delta. So this gives us the indication of aggressive buyers and aggressive sellers. The other thing we want to be using as traders is the volume, right? The volume, again, we want to be using the volume profile. So again, what the volume represents is the bid and the ask together. So it's the bid and the ask. So if we quickly dissect one candle over here, let's dissect this candle, right? So this is our key level. This is our fair value gap. So when price comes into a fair value gap, and this is very, very important to understand, right? Only when price comes into a fair value gap are we looking for this entry model. And this is a entry model that I use myself personally on the 1 minute time frame. Right, so here on the 5 minute time frame, we can catch the same trade on the 5 minute time frame. So if we dissect this red candle over here, we can see the candle body is red, right? But already it's really interesting. It's super interesting how we understand that the majority of the volume is situated in the lower half of the candle. We see a large amount of volume over here. What does this large amount of volume correspond to? Well, it corresponds to red delta. Red delta is aggressive selling. So that's really easy to understand, right? So the reason this strategy is essentially the backbone of every strategy and it works across every market and it's the best strategy you can use is because it doesn't lie to you. It's not going to give you a fake out liquidity sweep like the ICT concept. It's not going to give you a fake boss or a fake liquidity sweep. When you can read the numbers and understand who is actually in control at key levels, it really doesn't get more accurate than this. And this is what I want traders to understand. I want traders to at least walk away with the power of understanding the market is an auction. This auction can be read. And once the auction is read, it's very difficult to get the direction wrong if you are patient and you are fearless to execute at the right time. So we have a red candle over here with a massive amount of aggressive selling. If we dissect this candle even further, what we read over here, as price comes into the level, we see 277 market participants hitting the bid versus only 64 hitting the ask, right? 277 for 64, right? That is a large discrepancy between the aggressive sellers and the aggressive buyers. Hence why we see a very, very large red imprint of the delta. Likewise, above 418 for 281. Again, that's a large shift towards aggressive selling. Very, very important to understand this. Now, the next candle is even more interesting, where it's actually a green candle. We have a wick over here and we have a green candle. But the candle itself doesn't tell you anything. When you dive into this candle, what you really understand is that there's more sellers than there are buyers inside of a green candle. I want to repeat that again. You have a green candle with more sellers than buyers, right? Everyone sees a green candle and thinks, let's buy. Well, the truth is, no, you don't really want to be buying at a green candle randomly. You want to understand what's happening inside of the green candle, right? So this is 210 for 76. This means that there's a lot more aggressive sellers than buyers. Now, when we come into a bullish fair value gap, we want the fair value gap to hold. So let's just quickly read the order flow and see what we end up getting, right? This is what's super interesting about this. Now, we see the next candle over here. This is, of course, across a 15-minute period. We see the same thing over here. And this is what I want traders to understand. The behavior at this fair value gap is the most interesting thing, right? We want to see negative delta that isn't being rewarded. So what we see over here, and over here, and a little bit over here is that we see aggressive sellers which are not being rewarded. Because if the aggressive sellers were being rewarded, we would have seen lower prices. We would have seen price come and retest lower. But price simply couldn't break much below this fair value gap. So when you see a lot of aggressive sellers, but with no reward, what does that tell you? Now, for every seller, there's a buyer, and for every buyer, there's a seller. So when you have lots of aggressive selling, what this really represents to us as traders is that there's passive buyers sitting at this level. And I want traders to understand this. Let's really break down one candle and let's really understand this, right? So let's look over here, for example, this green candle, again, very interesting. This was a green candle, but we had a wick over here, right? So if we just kind of break this back to a regular candlestick chart, what we see over here is this large green candle, which essentially was the entry candle, right? You could have entered anywhere on that candle with a stop loss just below these wicks. Now, what really gave me the indication to buy was, number one, we had a green candle, which means that the buyers are starting to step in. But what really gives traders the indication to look for valid buys over here is the fact that we had a ton of aggressive selling down here, which is something the candlesticks themselves will not show you. We had a ton of aggressive sellers down here. We can even read the order flow. We had 340 for 276, right? That does not mean there are more aggressive sellers than there are aggressive buyers, right? That means, that does not mean there's more sellers than buyers. That means there's more aggressive sellers than there are aggressive buyers. But there aren't just aggressive participants. There are passive participants also in the markets. So when we see 340 aggressive sellers for only 276, that's roughly let's just say an 80 difference. The delta is 80, right? The delta is 80. So if there's more sellers, aggressive sellers, than there are aggressive buyers, and the market moves up, that means that there's passive buyers that are holding the level. And this is what really validates a fair value gap. Now, when you see aggressive buyers, right? Sorry, when you see aggressive sellers that don't get rewarded, it means that there's more passive buyers than there are aggressive sellers, right? That's important to understand. Also, from here, we see a very, very large switch of the delta, right? So we see a very, very large switch of the delta. We go from a massive negative delta to then a massive positive delta. Because if we look at the number just above this, we get 156 for 327. So we have double the amount of aggressive buyers than aggressive sellers after this absorption down here. So we have seen an absorption down here. We've seen an absorption of sellers, which means that the sellers have failed. Buyers are in control. That's what gives us the indication to take buys from within this candle, right? Within this region. That's kind of the first trade you could have taken. Now, the second trade comes from this area, which is even more interesting. I love this. Now, this was the area. This was the fair value gap. This was the fair value gap candle over here. All right. So let's dissect how price actually behaved over here. And it's super interesting. This candle, and this candle. Now, if we look at it again from an order flow perspective, from a candlestick perspective, you don't really know what's happening over here. You just know you see a large rally. But when we dive into these candles even further, using the power of volume and more importantly, the delta, what we see over here is we see again a lot of aggressive selling coming into this fair value gap. We see a ton of aggressive selling. The same thing on the next candle. We see a ton of aggressive selling over here. We see a ton of aggressive selling. In fact, we see 42 for 0. So think about what that means. 42 aggressive sellers came into this area. There were no aggressive buyers. Despite there being no aggressive buyers, the market still pumped up. So when there's no buyers and the market pumps up, this is a very, very strong indication that the market is being controlled by buyers. Because when there's only aggressive sellers, and aggressive sellers are hitting the market at live conditions, right? They're hitting the markets at those prices. So this is ES. Price was hitting at around 61.50 level, 61.51 area. There was a ton of activity all towards the downside. None of those aggressive sellers were actually rewarded. That is what gives you the indication to take buys. On top of that, if you look at the reaction candle over here, we had 5 for 0, which means the volume was tiny. We only had 5 transactions, which is a tiny volume. When you have a tiny volume, from the last session we went over, price isn't really interested in those areas. And that is why the markets move up in the first place, right? Because when there's a lack of volume, the markets will only move up and down. So you want to pair volume with the delta. When you see aggressive sellers and hence a negative delta with a low volume and price isn't going down, this just means buyers are in control. And it all comes from reading two numbers, which is the reason why I push order flow very heavily, because it is essentially the backbone behind every strategy. Right. And that's essentially the reason to taking longs. You could have taken longs roughly from this area if you missed this, and you could have taken longs from about the 52 area all the way up to about the 62 area. So fantastic trade over here, about a 1 to 3, 1 to 2, 1 to 4 hour trade, depending on how you managed it. Right. So that is essentially how order flow works. And it all comes down to the delta. Right. The delta, also the volume. Right. The delta is the ask minus the bid, aggressors versus passive participants. The volume tells you how many transactions occurred at that price. So once you can understand these two things and you compare it with the order flow, right, you can understand and think beyond simple candles, right? Because the truth is, anyone can find a fair value gap. Anyone can find a liquidity sweep. Anyone can find a market structure shift, right? I get so many questions about these three things: liquidity, market structure shifts, fair value gaps. Let me tell you something. If you're waiting for a market structure shift, more often than not, you will be late into the move. And the reason for that is because the market reacts off key levels before breaking structure. And you may not get price re-mitigate your fair value gap. So you need to assess fair value gaps in real time and understand what is going on behind everybody, but more so what's going on behind every wick. Because we're going to finish off the video with this, right? When you see a wick over here, right? This is a wick rejection. What a wick actually means from a technical perspective is that there's aggressive participants that are not being rewarded, and hence they're being absorbed by passive participants. And that's what's happening over here. Here we see a lot of aggressive sellers, right? We see 125 for 72. We see 42 for 0. So there's 42 aggressive sellers and none of them are being rewarded. What does that tell you? Aggressors are being absorbed by buyers. Passive buyers overpower aggressive sellers, and the aggressive buyers then step in. This is the reason you look for buys of every fair value gap. So it's not liquidity, it's not structure, it's not time, it's not OTE, it's none of those things. It comes down to using what the order flow is telling you, right? And this is essentially how I frame long trades. So again, if you like this video, give it a like, give it a thumbs up. I am offering free one-to-one sessions over at Price Action Labs, so feel free to book a session there. And I look forward to seeing all of you in the next one.